Welcome back, traders and investors, to the Benzinga Pre-Market Prep Show. My name is Garrett Cook. I'm filling in for Joel Elconin. I have with me a good friend of mine and somebody who is new to the Pre-Market Prep Show, well, as a guest, but he's been on many times before. Chris Angus, a nice listener, managing director at Cybor Quant. Chris, welcome to the show.
Hey, thanks, Gareth. Thanks for having me on the show. It's a privilege to be on, really. I've been a big fan and followed you guys for years. If you don't mind, I'll just throw in a disclaimer. I'm probably your one of most, how shall I say it, least experienced guests, self-taught, so to speak. And I've only been doing this, 4 or 5 years. So if anything sounds like it's a super noob statement, please refer back to this disclaimer. Um, so, and also, I may be one of your more unusual guests because I don't really have anything to sell, but I thought it'd be fun coming on the show. And as I said, it's a bit of a privilege, so let's get started.
Well, that'll be excellent. Yeah, Chris, I definitely enjoy going back and forth with you about markets and discussing what's going on. So maybe we can kind of take a top-down approach.
Yeah.
What's your view on the global market situation that we're dealing with right now? What do you see as, potential problems coming out of the ECB with other European, or with the Greek developments and the potential impact on the U.S. perhaps? We can start from that angle.
I mean, the most obvious thing to start off with is the quantitative easing and all the money that's been pumped into the eurozone. I think everyone was expecting Draghi to maybe say that the quantitative easing would be cut short today, but there was no such speak. So I think that the euro is going to keep getting pounded, and as such, my expectation is maybe that because of the excessive returns that you can see the European market starting to deliver, because all the slush money flowing around, that maybe some of that money, the investors' money, will come out of the US. So it's not. I don't think it's a great thing for the US, but I'm not the expert on these macroeconomic conditions, but that's my opinion anyway.
So does your outlet or the, individuals that you're working with, do you guys actively trade futures around the globe, or do you have them specifically focused in certain areas such as, US futures and perhaps German DAX futures or something to that effect?
Um, eh,
Or would you
when we started out initially, we focused on stuff that's around the globe.
Mhm.
But as we got more experienced and our techniques got more honed and we got slapped around a bit too much, we found that the relationships between the European indexes and those instruments weren't as solid as the US ones. So even though we're in the UK, small outfit, but we focus exclusively on US futures in terms of what we do. With the stimulus and all the quantitative easing that's going on, the correlations and the relationships between the European instruments, it's kind of crazy. So I've seen some big positions swing quite badly against us in the past, and we prefer to stick with the safe stuff. So, the S&P, Wall Street, Nasdaq, and Russell, and so on.
So when you guys are entering the markets, are you looking over your shoulders for any U.S. Fed hikes? What's your view on the U.S. market and the potential and all this? Everybody going back and forth about, if patient matters, if the Fed's going to raise, how quick they're going to raise, and all this other jibber jabbering.
So I think we've had a bit of back and forth, and we may be in a bit of a disagreement. But my forecast and the people I speak to is that the rate hike is going to happen sometime around January. Um, I think there was some further weakness with all the reports in the last couple of days as well. Mortgage applications declined, I think, today. Purchases down. Refinances fell 1.8%. Empire Manufacturing down. This is just putting like the day that they're actually Yellen's gonna raise the interest rates further and further back, in my opinion. So right now we're January. Tomorrow I might be saying February, but I don't think it's saying that's going to happen in June or July or whatever.
That seems to be the angle here, is everybody's kind of starting to see a softer economy and expecting them to push things back. So I mean, hopefully we'll continue to see things like the E-mini ETF SPY. Hopefully we'll
Yeah,
continue to see
yeah.
that, kind of climbing up and creeping up a little bit. Same with IWMs and the Qs. So
Mhm.
I guess the expectation then is that the Fed's going to hopefully use this to kind of hinder its necessity in order to raise rates. Do you guys do anything with U.S. Treasury markets? Do you take a look at
We
anything like the yield curves?
We don't do any yield curve trading like one of your other guests does. One of the guys that I really look up to. But it's something that we're looking at in the future. The problem is that with the platform that we trade on and the setup that we do, yield curve trading, because it's inherently pretty low margin stuff, it makes it unprofitable for us. But as we merge across and move into trading away from a synthetic market, because what we do is we trade in a synthetic market at the moment for various reasons. We'll move into that. But at the moment, our setup is predominantly and exclusively trading US futures. We don't do any yield curve stuff.
What's this synthetic market you were talking about? Can you tell me more about that?
Sure. So I think what we basically do in a nutshell is we're spread traders. So we're buying one future and selling another, depending if we are using a mean reversion or trend following strategy. Now, we started using a synthetic market because it's easier to work with as kind of a newcomer to the industry. I trade through a broker called IG Index, which is a spread betting broker.
Yep.
So that there's a couple upsides and downsides to that. Number one, if you use it as a spread betting platform, which it mimics the real market, point for point, it means you don't pay any tax here in the UK, which obviously offers significant benefits if you're a successful trader. The downside is the spreads that you pay are really, really wide. So the commissions work out 4 or 5 times what you may get from a deep discount broker, but it mimics the market point for point. It's exactly, otherwise they would get picked off really. But another one of the upsides is that you don't really have to worry about fills because you're trading almost against the broker. You're not actually, because they have a book and they like to keep that in balance. So, but fundamentally you're trading against the broker, so fills aren't really ever an issue. And that's the synthetic market, so to speak, where there's a broker, there's two sides to the trade, but those trades are completely internalized for the most part.
Oh, excellent. Okay, well, thank you for that, then. I appreciate that explanation. So I'm taking a look at futures here. We're starting to correct a little bit. We had some decent, decent levels of economic information this morning. It looks like capacity
Yeah.
utilization rate dropped a little bit in the U.S., industrial production dropped a little bit in the U.S., and then we have the ever-popular beige book coming out this afternoon. On top
Uh-huh.
of the fact that we've had, I believe it was Locker speaking tonight and Fisher speaking this morning from the Federal Reserve. So, what's your view for the beige book? What do you think the U.S. economy is going to be reporting this afternoon?
I'm gonna have to pass on that one,
Okay.
Garrett. I'm afraid. I don't really have much to say that's not out there already.
Yeah, and it's kind of tough to gauge what they're going to be saying, anyways. It seems to be toting the line that manufacturing is going to strengthen, and we'll see a little dip down in
I
retail
don't know. I
PMs.
mean, every time I look at it, not to contradict myself though, but I think every time I see manufacturing's down, and they're saying manufacturing's up. I mean, like, I don't want to get into like a whole he said, she said thing. That's why I'm avoiding the beige book thing.
Completely understandable. So do you have an outlook for the e-minis and the spies ETFs for the year? Are you seeing the markets closing up at the end of the year, or you think we're going to stay stable throughout the rest of the year and just kind of keep this
I
flat,
think
steady
from what
level?
I'm seeing, at least in the very short term, I'm expecting the E-minis to test their most recent highs pretty shortly. That's kind of the expectation. And then, if I just look back and look at how things play out historically, and we are still in a bull market, and it seems like we're in a phase of consolidation, somewhat fragile. But I think we'll close up on the year for sure. I expect a close of at least around 2,200. And maybe even a little bit higher. But I don't think it's going to be an amazing year like it was last year. But I think it will. I think there's still some gas in this elephant yet, and we may see it go just a bit higher and close the year a bit more positively because we're really not up that much on the year so far.
All right. Well, I got to ask you then also, if I could, about oil.
Yeah.
We've had this huge breakdown in the commodities sector. What's your view here? Anything unique to add to the story aside from just it looks like supply issues and potential M&A? Do you have any views on M&A coming forward here, as everybody seems to get prepared for a big integrated purchase of either a refiner or another integrated major oil company?
I mean, I'm a bit of a conspiracy theorist. So if we take a step back, I mean, I think that there was some heavy manipulation not only on the oil markets, but with the Saudis driving the price down. I mean, that's pretty much an open secret. But also with manipulation of the gold markets, so they tied together hand in hand. And I think the oil market's got a little way to go, but I think that in the very short term, maybe in the next 3 to 6 months, we're going to see a really big rally back in oil as everyone starts to buy because it's really good. It's not far off being at the bottom, I don't think. So I kind of like oil if you got the balls for it.
Yeah, it seems like we've hung around these lower levels for a decent amount of time now, and the market seems to be kind of accepting what's going on. And here in the U.S., it's a little easier for us to, obviously track retail sales of gasoline here, and I've noticed that the prices last time, when oil went really low, they were able to keep retail prices relatively elevated, at the pump. And I don't know what the scene is like over in the UK, but I know that that's, clearly benefits, things like refiner margins, even though we keep producing oil.
I mean, all the guys here in the UK are shouting, oil, the low oil prices are good, they're good. We don't, as far as I know, it's not a statistic I follow by any rate, that we don't actually know how much oil we're sucking up out the pumps. But I know that the lower oil price in combination with the QE that's going on in the EU is going to do some really good things for the economy over here. So we see it really as an overall good thing, even if it is making some US companies take a bit of short-term pain. And of course, in the UK as well, they're starting to look at fracking. They've been fracking for a long time, but they really want to push into fracking in a big way. And I think when the oil price is low, it's not such a bad time to enter because those guys they've got to raise a lot of money. And when the oil price is low, the expectation's a bit lower than if the oil price is well over $100 a barrel. So I think. Overall, oil's got a long way to climb back, but I think there's going to be some big jumps back towards that kind of 60, $80 level from not only the US consumption level, but also from the Europeans as well.
Okay, excellent. Well, Christopher, I appreciate you taking time and coming on this morning to speak with us. Taking time out of the UK day to come on. It was good talking with you. Thank
Thanks for
you.
having me. It's been a privilege, and hopefully you'll have me on again.
Oh, certainly, Chris. Certainly, we will. Thank you. So, ladies and
Thanks a
gentlemen,
lot.
we've been speaking with Christopher Angus, Managing Director over at Cybor Quant in the UK.